and welcome to the first of our three-part pre-budget series, Balancing Growth and Deficit. This is the first episode in this three-part series where we will discuss with experts what should be the economic philosophy underpinning the budget. Our questions are, should it focus on fiscal prudence? If yes, what is needed to achieve that prudence? 2, should it focus on growth? If yes, should it be farm first and then infra, or the other way around? And finally, if it is a bit of both, then what should be the ideal mix? Joining me in this maiden Economist roundtable are Dr. Rakesh Mohan, former Deputy Governor, Reserve Bank and former Executive Director at the IMF, Professor Govinda, former member of the Prime Minister's Economic Advisory Council and member of the 14th Finance Commission, Ajit Ranade, Chief Economist at the Aditya Brla Group, and Prasanna, Chief Economist, ICICI Securities Primary Dealer. Gentlemen, thank you very much for joining me. Well, last week, the CSO released its advanced GDP estimates, pegging the FY18 GDP growth at just 6.5%, GVA much lower, 6.1%, lower than what government and RBI, government in particular, had anticipated. Their nominal growth was 11.75, and the nominal growth that the GVA forecast was just 9%. Now, this has bolstered the argument that fiscal slippage is very likely. Meanwhile, the economy, of course, is in need of a booster after those first quarter, after the FY18 numbers that we saw, as well as distress in the farm sector, which is very evident in the protests in the capital and across the countryside. So, will the budget be able to balance both these? Dr. Rakesh Mohan, first question to you, sir. In a situation like this, when there is fiscal disruption because of a major tax reform and there is so much of farm sector pain, is fiscal prudence the priority?
I think that given the kind of disruptions that we've experienced in 2017 and the growth slowdown that has happened presumably as a consequence, I think that we really need to concentrate our attentions to reigniting growth. Of course, fiscal prudence is a constant. I don't want to go into the particular numbers because that's a bit too much detail at the present time. But I think that it's very important to really refocus on rekindling growth in the economy, and particularly in industry and manufacturing. The most distressing figure in the data that have just been released is indeed the 4.6% manufacturing growth. And this is a big issue at the moment because since I'm now really based outside India, I'm looking much more at the world, that this is the first year, that is 2017, and the coming year 2018, where you have essentially a worldwide recovery taking place after almost 10 years. Of course, different economies have indeed grown at higher rates in the last 10 years, but this is the first year where the expectation is that worldwide global recovery is indeed broad-based. Second, that also very interestingly, this is the first time since 2008 that the expectation of trade growth is over 4%. It's the first time in over a decade. For emerging markets, it's something like 4.8% expectation in 2018. So my point is that this is an opportunity for India to leverage what we do domestically with the kind of global recovery that is taking place.
Well, I take your point, sir, that it's even more painful that our manufacturing should be at 4.6% at a time when global growth is firing, even in a written-off economy like Japan. I'm coming to that in a minute, but let me come to the man who's looking at it from the market. Prasanna, do we have the luxury, though, of giving growth an accent over fiscal deficit? What is the appetite of the market to be able to absorb, say, a 3.2% fiscal deficit even next year, or a higher government borrowing program than this year?
Yeah, so I think given that this year already the fiscal slippage is more or less a given, and also, I mean, which has been signaled by the government in the form of extra borrowing, I think the market is kind of prepared for a 3.2% kind of a deficit number for next year. Of course, if it goes higher, I mean, our own projection is the deficit will be higher. So suppose the government prints something like 3.5%. Which is our estimate, by the way, that would lead to a lot of surprise and a negative sentiment in the market. In terms of borrowing, yes, I mean, I think what we have to remember is the consolidated fiscal deficit or the general government deficit of both the central and states put together is very high in India. And therefore, when you look at borrowings also, you have to look at the entire, the total figure. And this year, this financial year, for example, I think both central and states together must be borrowing around 10.5, 10.6 trillion. And our sense is by next year, probably this number will go up to rupees 11 trillion. So that is the extent of borrowing which you're asking the bond market to support. And then probably one has to brainstorm and see that how much excess funds will remain in the system to support private sector credit growth after meeting this borrowing requirement.
Okay. So would your sense therefore be that if the borrowing number were to be higher, there is a very good chance that this lower cost of capital advantage may go away and the cost of capital could rise, Prasanna?
That is right. So already we have seen in the bond market that there's been a sell-off, right? So even without the RBI doing anything, the cost of funding is actually going up for corporates. Any corporate which is preferring to borrow medium to long term, that has gone up already. And if the fiscal deficit is going to be much higher than what anyone anticipated, and if that is seen as pushing up growth and therefore inflation at a later point in time, then at some point even the MPC will decide that some monetary tightening would be required, which would mean again that even at the short end the cost of funding will go up.
Okay. Ajit, you represent a group which has something to say on both sides. A high infra spend or a pump priming of some kind by the government may help investments in the private sector, but at the same time, cost of money could rise. Which way would you tilt, growth or deficit, fiscal prudence?
It's not an easy trade-off, Latha. As Dr. Rakesh Mohan said, that this is the first time that we have synchronized global growth. And at this time, we also have India's growth rate projected to be the lowest in the last 4 years. And if you look at the 4 growth drivers, consumption spending, investment spending, especially private sector, net exports, and government. So the first 3 are not up to potential, maybe they are sputtering. So we definitely need a growth push. The yields, government yields on, say, 10-year GSEC have gone roughly from 6.7 to 7.3, 7.4, which is almost a 10% movement in the yields, which translates on a sustained annual basis of something like 50,000 crores in extra interest payment. But on the other hand, if you can get about 1 or 2 percentage point increase in the growth rates, that is almost 3 lakh crores. So that's why it's a difficult trade-off. And remember, let's not forget that India's demography is, it is young, it's a structural advantage. So today's borrowing is tomorrow's taxpayers, tax collection. So, when you spend it on infrastructure today, the infrastructure assets live for multiple generations. So therefore, the next unborn generation should also have a fair share of their burden of the cost of infrastructure. So in that sense also, I think the sanctity of, it's not the number itself, but the sanctity and credibility of a promise. So even if it's 3.5% of GDP, so to achieve that number is more important than the number being itself 3 or 3.1. So whatever number is decided, and I think it should be on the higher side, the government should try and stick to that number. But even if it's 3.5 or even 3.7.
Okay, that's 2 people saying very clearly that the accent should be on growth. About this argument of future generations bearing, I'm not convinced, but we may not have the luxury to debate that. I think this is the argument with which the Indian government has been imposing a higher debt to GDP for the past several decades now, and infrastructure has not really improved, and we are paying out for all those high interest accumulation or debt accumulation. But Dr. Govinda Rao, where would you stand, sir? I think you've seen the largest number of fiscal deficits from your perch at NIPFP. What would you say? Should growth be given an advantage?
Well, I think growth should definitely get an advantage. But growth should get an advantage not by pushing government expenditure, but by reviving the industrial climate in the country. And revival of the industrial climate in the country will have to be done through many other measures, including how effectively the effective functioning of the NCLT. You really have to deal with the twin balance sheet crisis. In fact, if you continue with the type of deficit that we have, one is there is a credibility of the government itself.
Yes.
In fact, recent report of the Controller and Auditor General says there are almost 80,000 crores where actually the bills were actually postponed in 2015-16.
Yes.
So there is a huge problem of credibility. And on top of it, you have the international interest rates rising, petroleum prices rising, and with all this, if you say that I will also have a larger deficit, you may end up with the twin deficit problem of both current account deficit and the fiscal deficit problem. I think the solution will have to be to revive the industrial climate, which would mean that we need to really reform our subsidy regime, and if we could go about doing demonetization the way we did, certainly the government can muster sufficient courage to reform the subsidies, particularly the fertilizer subsidies. And we do need to really sell off unwanted public enterprises, and we need to really do much more to contain the revenue deficit and release funds for capital creation, infrastructure creation, and at the same time revive the industrial climate in the economy, for which you need to contain the deficits.
Okay. Sir, I'll come back to the credibility argument. There are serious problems with even the April-November numbers that we have. IGST, you have a number, but you're very sure that the state's share has not gone. And now we have fresh doubts that even the direct tax collections are looking big because refunds have not been paid out. We don't know how many of these stories are true, but credibility is an issue across several numbers. But I want to take your point that, we have to encourage growth, and that need not necessarily come at the expense of deficit. We can, at the expense of fiscal prudence, it can come otherwise. Ajit, on that, an excellent article that you wrote, I think, a year ago, that the time has come for long-term capital gains on shares to be taxed. Would you say that is a sitting duck which we should shoot in this budget?
Oh, absolutely. Meaning, see, among the various priorities in this budget are job creation, farm sector, exports, investment in private sector investment, but also the fact that the share of indirect taxes is rising. For the last 3 years, it's steadily gone up to almost 55%. And India's direct tax to GDP ratio is among the lowest among its peers in the world. And, the tax department says something like 60 to 70,000 crores of capital gains are going tax-free. And, we need to have a very uniform treatment of all long-term capital gains of all asset classes, shares, real estate, private equity. And I believe, like in most countries, that is about 3 years. So we need, and by the way, the people who make income on long-term capital gains typically tend to be more wealthy people. So we also have to worry about the fact that higher share of indirect taxes is inherently regressive.
Yes.
So we need to correct that skew. So I think the time has come to look squarely at this capital gains exemption, which, by the way, has come because of the Mauritius Treaty from 1983. Exactly. So that was the tail wagging the dog. So the Mauritius Treaty was amended by this government last year, and now the time has come to just straighten it out and go back to 3 years of long-term capital gains exemption.
Okay. Well, that would be a happy situation where perhaps we could have both growth, some money for pump priming growth, and meet fiscal discipline as well. But I'll pose that question to our other experts in a minute after this break.